The USA has been in a 16-year bull market. So when will it end? In this video, I'm going to break down some things I'm going to be looking for to show maybe not the end of the 16-year bull market, but periods of times where it could slow down, consolidation could form, it could be a good dip to buy, and all those types of things. Remember, this is according to my own research. This is my personal analysis. It's chart-based. This isn't financial advice. If you want to keep up to date what I'm doing in financial markets, I do have a free newsletter. Link to that will be in the description. So look, 16-year bull market. Here we are. So what I'm showing here is the S&P 500 on the monthly chart with the 12 and 21 EMA. And look, the trend, it speaks for itself. As you can see here, we got bullish in and around kind of mid 2010, I believe it was July time, and we've been up and to the right. Almost cross bearish there, but it was almost a great, you could say, dip to buy. On the NASDAQ, we did actually cross bearish there, so I thought it'd be worth flagging, but look, the trend's been great. Any dip into that 21 has been a great dip to buy. Even COVID, no. Obviously 2008 we were bearish, came out of that, and we've been bullish ever since. So that for me is just marking of this 6-year trend. We've been bullish. It's been long America for this 16-year period, essentially. Yes, you could argue you had great accumulation zones in the lost decade in between 2000 and 2010, but you could have just said, I'm going long America, and boom, you would have done exceptionally well. So yeah, they've been bullish since July 2010. So that's approaching, 16 years, assuming we don't see anything, crazy towards the end of this month. And the 12 and 21 EMA on the monthly have not crossed bearish since then. So this is 16 years of a confirmed bullish trend on the highest time frame. No crossovers, no, structural breaks regarding those EMAs. If we go back here, you could argue, okay, bearish there. But when we have those bearish ones, we've either gone straight back up or there. And because the EMA is slower to react than price, in some scenarios, it can actually show a better representation. If you were to exit everything on that bearish market structure break and got back in there, in the grand scheme of things, it wouldn't have looked, that bad. But, you could have just waited for those EMAs to cross. So you could argue either or, really. Market structure breaks in this scenario haven't been as good as an EMA trend. They both obviously work. They both can be wrong. They both can be right. But in this situation, the EMA trend has been speaking for itself. So look, the S&P has produced one of the greatest bull markets in modern financial history. Probably has been, ever since the 2008 crisis. The S&P 500 has been the one. I mean, you see everyone online. The S&P this, the S&P that. Just buy and hold the S&P. It has been exceptional. Prices, multiplied more than 7 times, and when they first turned bullish. Anyone who stayed long has been rewarded significantly. The EMA stacking, bullishly is the clearest sign of that trend health, as we spoke about earlier. When the fastest is below the slowest one, easy, bang, we're bullish. It's a really easy thing to understand. And when it's the other way around, when you've got the fast and the slow going down, we're bearish. But this does not mean it will last forever. Trends do end, right? If you go on to a 1 minute, you will see something similar. But obviously it's a 1 minute. So you might see something, I don't know, on this might be a daily trend, or I guess you could say a daily trend could be within this part, right? So these things do come to an end, and I think I do believe the stock markets go up and to the right, yes, but are you going to get this trend like that on this ongoing trend? I don't know. The jury's definitely out, because this has been a very long trend. And would we be expecting almost like a decade of consolidation before another one of these? Potentially. Obviously, you can't pattern match, but these are possibilities you have got to be thinking of. So look, this is on a yearly chart. So as you can see here, zooming out to the yearly chart, these have actually never crossed bearish, which I think is a really good frame to have. Even in the lost decade, overextended, consolidated, dipped back here, and we went. So are we going to see something similar? 2018, 2020, 2022, all dipped back into the EMAs, but are we going to see one into that, that bottom one there? Who knows? You could argue these are the ultimate buying opportunities, and waiting for that retest could be the best now. You've obviously got to be extremely patient, if you're waiting since that, I guess around, 2010, 2008, in and around that time. Waiting then extremely, patient. But that could be the system, right? But zooming out, to the yearly chart, it just gives you a clear picture. This is going up and to the right, but it looks overextended just by looking at that, and definitely consolidation is probably needed. But I would not be guessing or betting against the S&P 500, that's for sure. And look, the Japanese warning. So as you can see here, we had a huge move in Japan, and then we didn't have any new highs for a while until recently, until the last decade or so, right? So the Nikkei did this, and I think it's important to know that an 80% drawdown, probably I don't see it happening to America, because being too bearish is a fool's game. Calling tops on this, you could have called it there, you would have been right. Well, it just chopped. Could have called one there, could have called one there, could have called one there, could be calling one here. So, right, being too bearish is a fool's game, but, you've got to be aware this is a potential possibility. So I wanted to just throw this in to say, when they do cross bearish, this could happen, but I would expect more of a sideways action for that moving average to catch up. But, it'd be interesting to see, right? So let's say, for example, this is a monthly. We go back to this monthly chart here on the S&P, you'd maybe expect it to come back down. If they're now bearish, that next retest is really important. Does it reclaim, or does it, retest and go lower? That, retest is, for me, the most important thing. So that kind of there and that one there. That would be a sign of the times, but these obviously going to play over months. But I wanted to put this in, just did happen to Japan. What would actually end it? So a monthly, EMA cross is not a signal to act. It's a confirmation that the environment's, changed. So monthly crosses, yearly crosses, or reclaims and all that stuff, they can be quite slow, right? So you're going to see a bearish day and a bearish weekly, ages before, probably days and weeks before, the monthly EMAs cross. So this could be maybe a time to take some chips off the table, time to risk less, time to, be a bit more conservative and wait for that cross to come. So a sustained monthly close below the 21 EMA would be the first warning, because crosses take time, but a close below, you might get a move back up and a move back down. That for me would be, again, another sign. If we go to Japan, close below there, retest there, not quite crossed, but went down. So that close below would be a very telling sign, right? So that's what, I would be trying to think about and, be considering if that does happen. So a bearish day 12, 21 cross on the monthly would be the confirmation. So close below is a warning, cross confirmation. So mean reversion, on the 6-year bull market, it could be significant. It could be years. It could be absolutely years. But as I mentioned, being too bearish is a fool's game. You just want to be, you always want to be optimistic in markets. Obviously not too optimistic within reason, but I think it's better to be optimistic than be bearish. But a mean reversion on a 16-year bull market could be very significant for another accumulation to go up. So this is confirmation. It's not signal to act, right? So as I mentioned earlier, the monthly chart is the last piece of the puzzle. It's, it's a great way to zoom out. I think, just check it on a monthly basis when it changes, right? Crazy. But, you want to be zooming out, viewing the monthly chart. It's like, okay, cool, this is where we're at. If you do see a cross on a monthly, time to, rein it in a little bit. But, the weekly chart will confirm this. When you see a very bearish weekly, usually the monthly's coming. The daily chart will give you, earlier warning signs. But what, you could think about is, okay, cool, if we've got a weekly, a bearish weekly, zoom out to a monthly. Okay, cool, where are we at? And if we're retesting those levels, how are we reacting? So use, the monthly as the context and not the trigger. Use that as like a broad view. Use it as almost like your map, I would say, for your lower time frames and your more, daily, weekly decisions. The trend is intact until the chart says otherwise. Right now it's intact. 15 years or so, bullish EMA structure on the monthly. We've had all-time highs consistently. We've test gone up. Will that keep happening? Who knows? But for me, the monthly would be a great guide to know whether the USA bull market is going to end. The verdict. The 12 and the 21 EMA on the monthly have been bullish for 16 years. 3 serious tests, 3 fails to break, the structure to break lower. The trend is intact. That's what is happening now. We are bullish. Japan shows what the other side looks like, and obviously it's unlikely, but it can happen. 80% drawdown over 20 years. The monthly EMAs have been a great, kind of way to guide your way through that. So, as I mentioned earlier, you take chips off the table, or you be a bit more conservative. When we're bearish, watch the weekly and the daily first. They'll confirm, but the monthly is the final, nail in the coffin, the confirmation. If you want to keep up to date with all this stuff, I do have a free newsletter. I guess to summarize on America, look, 16-year bull market, significant. You build. It's cause and effect, right? So you chop there, and then you build, you mark up. Usually the markup is less than the range. So what I would be expecting if we are to cross is a very, very long accumulation in US stocks. But time will tell. Thank you very much for watching, guys. Sign up to the newsletter. See you in the next one.